Welcome to the continuation of commerce. Um, we are going to discuss insurance part one. Okay, so this is one of the aids to trade insurance. So we're going to take a look at part one of insurance. I would like to take this opportunity also to let you know that we are on Pathfinder. So Pathfinder is a new app where you can find tutors for different subjects. We're also there, and my team is also there. So in case you need tuitions or you need a tutor, if you are not with us already, you can just check us there. There are sample videos. You can check how we teach, sample lessons, exercises, and all. So you can check how we teach. Then from there, you, in case you're interested, you can start tuitions with us. The link to the app is in the description, down in the description. Yeah, though as of now the app is just on Android. For those with iPhones, you have to wait a bit. Okay, so what is insurance? So insurance is a commercial service which protects traders against financial losses caused by risks such as fire, theft, accidents, etc. Remember, insurance is one of the aids to trade. That's why we're discussing it here. Okay, so the statement says it protects traders against financial losses caused by risks such as fire, theft. Okay, so in business, there are things that can happen that can end up destroying the business. For example, you have a shop, you are doing everything it takes to make sure that your shop is not affected by fire. Okay, so you have fire extinguisher, you have everything. Then your neighbor, it's not like you, they don't care about that. So the neighbor's shop ends up catching fire, then that fire spreads to your shop. Okay, and that fire destroys your shop. It means all your investment has gone in water, all your investment has been in vain. Okay, so what can you do to make sure that you don't encounter such things? Okay, you have to protect your assets in advance. Okay, so you have to make sure that all your goods, your shop is insured. When it's insured, it means in case an incident has happened, the insurance company is going to pay you for the loss you are going to suffer. Okay, so what is the importance of insurance? First, that come from saying is to cover goods or assets in advance against financial loss. So in advance means before something bad happens, you protect it, so that when that bad things happens, then you are going to be able to make sure that you don't suffer a loss. Okay, the next importance is to cover employers against injury or death while at work. Okay, so you have a company, you have workers. So one of your worker dies at work, you have to pay a lot of money, provided that maybe it was your negligence or something. Okay, so the insurance company comes in to help you in that. Okay, it covers risks such as fire, accidents, or floods. In case there are floods in Kanyama where your shop is, then of course the flood ends up destroying some goods in your shop. Okay, maybe you sell meal and that meal becomes bad because of the flood. The insurance company is going to pay you. Finally, it compensates traders in case of financial loss through third-party claims such as public liability, employer's liability, and loss of raw materials, equipment, or property. Okay, so just to emphasize on the previous points, what are the importance of taking out an insurance cover by traders or business people? Okay, so here we don't want to look at companies, we just want to look at businesses which are not companies. There's a difference between a business and a company. Okay, remember the formation of companies. Okay, a company is also a business, but not all businesses are companies. Okay, For example, sole trade, it's a business, but it's not a company. Partnership, it's a business, but it's not a company. Okay, so the previous importances were from discussing for um, for business, for the business environment, for all types of businesses. But here we're going to focus on small businesses, or should I say businesses like sole traders and partnership. So if a loss occurs, he or she will receive compensation or be indemnified. So this word indemnified means the same as compensation, meaning that you are going to be given back the money after a loss. Okay. He or she may not end up going out of business if her or his business is large, as his losses could be large. Okay, so if you have a big business, then you make a big loss, like you have a big shop with lots of things, then the whole shop is destroyed. Okay, then you won't go out of business because you're going to be compensated for that. It will give traders confidence to continue in business. Because of this, you will continue in business. Insurance at first may seem to be a loss of money, because during insurance, when you have something insured or your goods insured, you'll be paying money even if there's no bad incident happening. Okay, so it might seem to be a loss, but when something bad happens, you are going to appreciate that it wasn't a loss, because your business won't go down. Okay. Okay, so what are some of the risks that a trader or company may insure against? Okay, so a company or trader can insure against fire, like I explained before. They can also insure against theft, in case thieves break in. They can make sure that whatever is going to be stolen, it's going to be recovered in form of insurance. There was an incident that happened where I grew up from. I think it was the time when gassing was rampant in Zambia, especially especially in Lusaka, I'm not sure. Yeah, but in Kanyama, there was a trend where junkies could go, or should I say junkie? Yeah, so the junkie could go and break the shops for traders, and and steal everything, or get everything in that shop in the name of trying to expose the gassers. Okay, but there was one who was always nonchalant about it, meaning they were never moved. Okay, because their goods were insured, so the junkie could go in and steal things, then next day the shop will be full again. So that's the importance of insurance. Okay, because once those things are stolen, the insurance company was paying them back. There is also a trader company can insure against public liability. They can also insure against accidents, okay, in case an accident has occurred in terms of maybe their property, for example, vehicle that delivers maybe soap, or should I say boom, from one point to the other. In case it is involved in an accident, then it's going to be insured. Employer's liability. So employer's liability refers to legal issues that a business may involve itself with its workers and the likes. Okay, so in case a worker is about, maybe they did not, okay, let's say there's a dispute between the owner of the company and the worker, then it reaches to the court, then the company ends up losing. So that is going to be covered by the insurance company. There's also, you can insure with against product liability. In case you sell a product that has failed to reach or to perform the way it was advertised, then the insurance company can cover that. So what do I mean? Let's say your business is you sell Chiwantu, okay? So or is it Tobwa? So now after selling, it is discovered that that Tobwa has gone bad, okay? so maybe it has become sour. So now people paid for that toba, and maybe it has given them problems, health problems, maybe stomach aches. Okay, so now they want you to pay for the money they paid you, and also for the health challenges they faced. So the insurance company can come and help you with that. There's also an issue of fidelity guarantee. Okay, so insurance makes sure that in a case where there's fidelity guarantee is deals with making sure that there is no dishonest between you and the business environment or your workers. So in case there is any problem that would come as a result of not being honest, then the insurance company is going to cover that. Okay, so fidelity guarantee is ensuring that no dishonest between you and your business environment. Next, we look at pooling of risks. Okay, so pooling of risks, as you can see, this word pooling is pool. Okay, pool, like a pool of water. Okay, let's go and swim in the pool. Okay, so pooling of risks, it's like where you make a pool, but this time instead of a pool that has water, you make a pool that has risks. Okay, so what is this concept? So what this concept says is people with common risks pay into a common fund an amount known as premium from which the unfortunate are paid from. So in this situation, let's say a lot of traders at a given market, we can say whatever market that is near you. I wanted to give an example of maybe Sokone in Kitwe. So most traders, maybe their tomato goes bad, okay? So they want to ensure against making sure that that tomato, in case it goes bad, they recover, okay? So what they can do is they can start paying in they can start paying insurance to an insurance company that of course is able to cover that type of goods. Okay, so that amount they are going to pay is going to be called premium. So it can be a very small amount, so insignificant as compared to the price of the product. Okay, so now if this small amount, the premium, is being paid by a lot of traders, okay, so let's say one tomato costs 5 kwacha, then the premium is 50 ngwe. Okay, so the premium is 50 ngwe. So if we have 100 traders paying this 50 ngwe, then we're talking about maybe 50 kwacha. Okay, so meaning that every month 50 kwacha is going to be received by the insurance company. Okay, but not all of them can have the same problem at the same time. So maybe out of these 10, out of these 100, maybe 2 of them have their tomatoes gone bad. So the insurance company is going to get the 10 kwacha from that 50 kwacha and give one of the traders, and another 10 kwacha they are going to give another trader. So in short, a lot of people are going to be paying, they are going to be putting money in that pool, okay, so that in case one of them has a problem, then the insurance company can help them to sort it out. So here is more information. It's just what I'm from describing, but of course just putting in words properly. Okay, so the burden is made lighter than it would have been, because if a trader has lost 2 tomatoes, then they have to, it means they've lost 10 kwacha. Okay, but they're going to be given back that 10 kwacha. Okay, so the burden is made lighter than it would have been without insurance. Okay, also for a small amount of premium, the insured means the person who the business, the trader or the company, okay, that is expected to receive insurance. Okay, so for a small amount of premium, the insured is made to be paid the insured property. The insured property in our example is tomato. Okay, then the insured is the trader at Sokone. Okay, e.g. property worth 10 million might be insured for a premium of 300,000. Okay, so this means that a property can be worth 10 million, like our tomato, which was 5 kwacha, but the trader can be paying 300,000, like the 15 way for our trader in Sokoni market. Okay, hope you have the picture. So this is because there are many who wish to insure against the same risk. Many premiums are contributed, but there are proportionally fewer claims. Okay, a lot of people are contributing, but it's not always that all of them are going to have a problem at once. Therefore, it enables the fortunate people to help the unfortunate people. So it helps those who are lucky, who don't face problems, to be helping those who face problems. Also, the insurance company will use the money from the pool as follows. So this is how the insurance company will use the money from the pool. Okay. First, they are going to pay compensation to those who suffer losses. Okay, which is the main goal of insurance. Also, they are going to use part of the money to meet the running expenses such as salaries, rent, and bills. Remember, it's a company. It has people working in that company, in the insurance company. So these people have to be paid salaries. Okay, they also maybe rent buildings, so they have to pay rent, bills for electricity, and all. So that's how that money is going to be used. Also, it can be used to pay dividend to company shareholders. And finally, it can be used, the surplus funds, which means the extra money that remains, can be invested in property business and some lent out to the government. So the money that remains after doing all this can be used to invest in properties, in real estate, and part of it can be lent out to the government via government bonds. Okay, so let's take a look at business risks. So there are two types of business risks. There are insurable risks and non-insurable risks. Okay, so insurable risks are risks whose chances of occurring can be mathematically calculated from carefully kept past records of statistics. Okay, so using information about that given risks, let me say that again, using information about a given risk, you ask yourself, in the last 20 years, when has maybe theft happened on this shop? If it has happened 5 times, you expect in the next 20 years that it may happen again 5 times. So from there, you can calculate how much they should be paying. Okay, so to put in perspective, let's say we have you have a shop in Nevala, another shop in Chivolia. Okay, so you ask yourself, maybe in Chivolia there's too much theft, so maybe the chances of theft happening is frequent. Well, in Nevala there's no such, so you may end up be paying more for insurance for a shop in Chivolia than in Nevala, because according to past records, a shop in Chivolia has got theft incidents more than a shop in Nevada. So a fair premium can be calculated from the past records. Okay. Examples of insurable risks include fire, theft, accident, damage of property. So these things, it's possible to find them in past records. So then the second type of risks are called non-insurable risks. Okay, so what type of risks are these? So these are risks that cannot be assessed due to lack of past records. So they don't have past records, so we cannot assess them to see if we can calculate the amount of premium that should be paid to the insurance company. Okay, so their probability of occurring is not known. We don't know if they can happen or not, and therefore premium cannot be calculated with certainty. You can't be sure of the calculated premium or how to calculate it. So examples include loss of profit due to bad management. So of a company, the boss is just very bad, then you end up making losses. You cannot calculate this because for a company, it may be the first time it is making a loss. So how do you calculate that? Change of fashion, maybe you sell vans, the vans, okay? Or you sell, what are they called? I'm trying to recall a name of the trousers, the chinos. You sell chinos, then chinos are not in fashion. So the business is now making loss. It's difficult. You can't predict that. Natural calamity, maybe there's an earthquake. Yeah, I think 2 years ago there was a small earthquake that happened in Zambia, I think maybe or somewhere. Yeah, you cannot tell that. So now we look at principles of insurance. So these are key concepts or principles that govern the idea of insurance. The first is called insurable interest. Insurable interest. Okay, so what does that mean? So it states that only the person who stands to lose financially if a risk insured against occurs has the right to insure the property or life. Okay, we can insure property, we can insure a person's life. Okay, so what does that mean? It means that the person must usually own the property, he or she has to insure, meaning you cannot insure your friend's property. Okay, you want to insure a laptop, it should be your laptop with proof. So the whole idea is this principle prevents people who are not owners of the items from insuring it. Also, people cannot insure anything that does not suffer financial loss because he or she might be tempted to cause a loss. The second principle is called utmost good faith. Utmost good faith, or uberrima fides. Uberrima fides. Okay, that's the pronunciation there. Uberrima fides. Okay, so what is uberrima fides, or utmost good faith? So this principle states that both the insurance company and the person seeking insurance cover must say the truth or act in good faith by telling the truth without leaving out any facts. Okay, so when you're about to apply for insurance or to go into insurance, you and the company, both of you, need to tell the truth. Okay, without leaving out any facts. Okay, so for example, you want to insure your car against maybe damage, not knowing that it is already damaged, you are just lying. Okay, so that is not following the principle of utmost good faith. Therefore, if it is discovered that one of you lied, the contract will be void, meaning that that contract won't be binding you to, or it will be invalid. It applies when completing a proposal form so that the insurance company has all the information required in assessing the risk. They need to be given all the information to see the risk. Okay. Also, they should have all the information required in deciding whether to accept the risk or not. Also, they should have all the information required in able to fix a fair premium. Okay. The next principle is indemnity. You remember this word? When we're talking about compensation, this word came in. Okay. So what does the principle of indemnity say? So this one states that to restore the insured person to his or her former financial position without allowing him or her to make profit out of a loss. So this means that if you have made the loss of 10 kwacha, you are supposed to be given 10 kwacha. If you have made the loss of 30 kwacha, you are supposed to be given 30 kwacha. If your car is in an accident and for it to be repaired, it needs 2 kwacha, then you're supposed to be paid 2 kwacha. You are not supposed to make profit, okay? So the only exception is for life assurance, loss of limb, when you lose a hand or a leg, or maybe you are involved in an accident. That's where the principle of indemnity does not apply. Also, the insured should not over-insure or under-insure. So you, the person who is applying for insurance, you should not over-insure, meaning that you should not overstate the value of the item or the loss, or understate it, okay? So this principle of indemnity is supported by 2 other principles. That is the principle of subrogation and the principle of contribution. The principle of subrogation and, I made a mistake, it's supposed to be and the principle of contribution. So we're going to look at these 2 principles also, subrogation and contribution. So we look at contribution. So the principle of contribution states that if an item is insured with more than one insurance company, if the same item is destroyed by the risk insured against, the insurance companies involved would contribute proportionately towards the amount of compensation required without allowing the insured person making profit out of the loss. So if, for example, you insure your shop against fire accident, so that when it catches fire, you are paid, okay? But you insure your shop to 4 different insurance companies, okay? And that shop catches fire, and for it to be repaired, it needs 20 kwacha. Each of the insurance company has to contribute equally for that 20 kwacha. You won't get 20 kwacha from each of them, so that you have, there are 4 companies, so if you get 20 kwacha, it's going to be 80 kwacha, meaning that you're going to make more profit. Instead of just 20 kwacha, you're going to make 80 kwacha. So this 20 kwacha, each company is going to contribute a quarter of this 20 kwacha. What that means is each company is going to contribute 5 kwacha. Okay, there are 4 companies, so 5 kwacha, 5 kwacha, 5 kwacha, 5 kwacha, it will be 20 kwacha. Okay, so you are not supposed to make a profit. As you can see, this principle of contribution, okay, is in line with the principle of indemnity. Then subrogation says, it states that once the insured is compensated in full for the loss, the remains or wreck of damage or recovered items becomes the property of the insurance company. So if, for example, your car has been involved in an accident, okay, and after that, it cannot be repaired, so you need to be given, they need to buy for you a new car, okay, maybe it's 80,000, okay. So what the insurance company is going to do is, according to this principle, they are going to give you 80,000, but the car that was involved in the accident, it becomes their car, okay. Therefore, they can sell it, they can do whatever it takes. Another situation is if someone has stolen items for you, then the insurance company has paid you, then the insurance company is going to deal with the thief, okay. So instead of you dealing with the thief, they're going to deal with the thief. And if they manage to get this thief, and that thief, they manage to recover the things that were stolen or the money, then it is theirs, not yours. That's the principle of subrogation. So the insured must not be allowed to make profit out of the loss by receiving compensation money and keeping the wreck or removed item. Also, the right of ownership of the remains item passed to the insurance company immediately the insured is fully compensated or indemnified to his or her financial position. So I've explained this part already. Next, we look at the clause called average clause. So this principle of average clause says that when a property is underinsured at the time of loss, the policyholder, meaning the insured, will bear a proportion of the loss. Okay, so in case the value of an item is 10 kwacha, but when, of course, applying for insurance, you say it's 8 kwacha, okay? Then it is involved in an accident, and maybe the item has to be bought at 10 kwacha, okay? So the insurance company is just going to give you 8 kwacha, and you have to pay the 2 kwacha, so that the total 10 kwacha is recovered. Okay, so the point is you have to you don't have to under insure. Okay, you don't have to under insure the item, because if you under insure, it means you're going also to contribute to the loss, and therefore you have to pay to make sure that whatever damage you also contribute and the insurance company contributes. Okay, to understand this maybe we look at numbers. So there's a formula for the average clause. The formula is claim payable, which is the amount of money that the insurance company is going to pay you, is equal to the sum insured over the actual value, okay, times market value. Market value is the amount of money needed to repair the item, or to buy the new item, or to recover the item, okay, whatever is needed, whatever amount of money is needed to regain the original value of the item. That is the market value. Okay, so market value is just the same as loss incurred, in short. Also, in case, according to the average clause, you have undervalued, then to find the amount that you're going to pay, it's going to be the market value minus claim payable, meaning this market value, you are going to subtract the claim payable. That is the amount that the insurance company is going to pay you. Okay, it may look confusing here, but it's simple, as you are going to see. Let's take a look at this example. A vehicle is insured for 30 kwacha, and its value is 30,000, and this value is 30,000. So this vehicle, its value is 30,000. You go to the insurance company and you insure it for 30,000, meaning that you have not undervalued it. You have not undervalued it, right? You have used the right price. Cool. So it is damaged in fire, and the cost of repairing is valued at 20,000. Okay. So now, for it to be repaired, you need to pay 20,000. How much should the insurance company pay in compensations? How much should the insurance company pay in compensations? Okay, you did not lie here, so you're expected to pay. The insurance company is supposed to pay you the 20,000. You don't have to pay anything. You did not undervalue, okay, the insurer. You did not undervalue the item, okay. So the amount that the insurance company is supposed to pay you is just 20,000. Another example, Miss Johanna Naingwa had her shop insured at 100 kwacha when its value was 200 kwacha. So her shop was insured at 100 kwacha, but its value was 200 kwacha. Okay. Unfortunately, the shop had a fire accident. To be repaired, it needed 50 kwacha. How much would the insurance company pay, and would she pay? I think I did not finish typing this question. Oh no, it's there. How much would the insurance company going to pay her? Also, question B, how much is she going to contribute? So if you understand this question, the shop was insured at 100 kwacha, but its actual value is actually 200, so it was underinsured. Then, of course, there was a fire, and it needs 50 kwacha to be repaired. So this 50 kwacha would not come from the insurance company, all of it. Why? Because she undervalued. She said its value is 100 kwacha instead of 200 kwacha. So to know the amount that the insurance company is going to pay, we're going to use this formula. So claim payable is equal to sum insured over actual value. Sum insured over actual value times market value. Sum insured, okay, which is the 100, right? Actual value, the 200. Market value, the amount needed to repair it, okay, 50 kwacha. So when we put in the numbers, we're going to get 25 kwacha. So this is the amount of money that the insurance company is going to pay. But remember, for it to be repaired, it needs 50 kwacha. So if the insurance company pays 25 kwacha, it means 50 kwacha minus 25 kwacha is 25 kwacha. The remaining 25 kwacha has to be paid by Miss Johanna Naingwa. Therefore, the answer to B is amount to be paid by the police order. The police order is market value minus claim payable, okay, which is 50 kwacha minus 25 kwacha, which is 25 kwacha. Okay, the last principle we're going to look at is the proximate cause. Okay, so this one states that the insurance company would only compensate a person who has suffered a loss if the risk insured against is the immediate cause of the loss. What it means is, if you have insured your company against fire, your shop against fire damage, that if it is destroyed by fire, the insurance company pays you. If a flood destroys the shop, they are not going to pay you. They can only pay you if it's fire that has destroyed the shop. Okay? So example, if a car is insured against theft and then it is damaged in an accident, the car will not be replaced because it is damaged in an accident, not stolen as insured. So this marks the end of the first part of insurance. See you in the next part.